Hello traders, this is Simon, and in today's video I'll be talking about balance price range. I'll be showing you how you can use balance price range for trade entry. You know, balance price range according to ICT is one of the most powerful entry models you can add to your trading profile. Without wasting time, let me show you how balance price range, how it works, how you can utilize it for trade entry. Let's take for example, if you have something like this, if market creates a low and maybe we are having something like this to the upside and here becomes our swing low, then if market decide to visit this old low, for example, market is coming like this and take out this particular low, for example, you know that after market must have taken this low and maybe market gives us a fair value gap. You know that one thing that happens almost every time is that when price reads a sell side liquidity or buy side liquidity, market often creates a fair value gap. Let's say for example in this case now, this is market sweeping a sell side liquidity, this old low, swing low. You notice that in most cases market will provide a bearish fair value gap in that same range that took out liquidity. Why? Because this particular fair value gap created by price is showing aggressiveness to this downside, it's showing momentum to the downside. So majority of traders will try to utilize this bearish fair value gap to go lower. You understand? But this is the twist. In most cases, after raising this liquidity, market often aggressively close above the fair value gap like this. You understand? Market in most cases aggressively close above the fair value gap. So what are you looking for? Market offered us a bearish fair value gap before taking liquidity, and markets also aggressively closing above the fair value gap. So therefore creating a bearish fair value gap and also creating a bullish fair value gap. So the overlapping of a bearish fair value gap and a bullish fair value gap is what we call balance price range. So market often come back, retest the balance price range to go higher. So this is where you now get your entry. You understand? So the overlapping of a bearish fair value gap and a bullish fair value gap after taking liquidity, you understand, is what is known as balance price range. Same thing applies if market is, let me take out this. Let's assume if we flip this chart around, okay, let's say I am having a swing high here and market formally created a high here. You understand? And market went down aggressively. Then later, market now returns to this swing point and take liquidity. You understand? What we are after is we are looking to see if fair value gap created by price around this level is going to support price higher like this. You understand? So if this fair value gap fails to support price and price give us something like this, aggressively closing below the fair value gap created before, you understand? So the overlapping of the bearish fair value gap and the bullish fair value gap becomes our balance price range. So what we'll be looking out for is for price to return to the fair value gap and give us move to the downside. So overlapping of the bullish fair value gap and the bearish fair value gap now give us what we call balance price range. Quickly, let me go to my chart and show you some examples. This is on gold. 4-hour time frame. I want to bring your attention to what happened here. When gold was making lower low, lower high, and lower low, before gold took out this particular low, look at it. Gold created a bearish fair value gap. Look at it. Are you seeing it? And market came back, retested that fair value gap, but failed to close below this low, instead making a higher low. Then if you draw that fair value gap across, you notice that market also, price also clearly closed above this fair value gap here. So how do you draw out, how do you map out the overlapping fair value gap between the, as in the overlapping between the bearish fair value gap and the bullish fair value gap? Look at it. Are you seeing it? Let me zoom in. Look at it. This is where I got the overlapping between the bearish fair value gap and the bullish fair value gap. You must draw it in such a way that no other candle will interrupt them. Look at it. So if you draw this across to the right hand side, look at what happened. Later on, market came back and utilized this fair value gap, this balance price range to go higher. You understand? Let me show you another example. Still on gold. Look at what happened here. When market made a higher high, higher low, higher high, market created a fair value gap. The market took out liquidity above this high. You understand? And this fair value gap now failed to support price higher. Instead, market also clearly closed below the fair value gap. So the overlapping between the bullish fair value gap and this very fair value gap gives us a balanced price range. So if you draw it across, look at where the supported price. You understand? Let me quickly give you another example on Euro USD. On Euro USD, look at what happened here. On Euro USD. Look at. Market was coming down, lower low, lower high, lower low. Market swept liquidity below this old low. You understand? And the leg that swept the liquidity, look at, we are having a fair value gap here. Look at it. Let me remove this. Market created a bearish fair value gap here. Are you seeing it? And after creating the bearish fair value gap, we took liquidity, and market quickly also closed above the fair value gap. Look at it. So look at the overlapping here and here now is where we got the overlapping between the two fair value gap, between the bearish fair value gap and the bullish fair value gap. So if you draw it across, look at where it supported price higher. Look at it. So before you identify a balanced price range, price must first of all take out liquidity, be it buy side or sell side liquidity. Then after price must have taken liquidity, then the leg that swept liquidity, make sure that price creates a fair value gap there, be it bullish fair value gap or bearish fair value gap. Then you need to wait for price to aggressively close above the bullish fair value gap or below the bearish fair value gap. You understand? So the overlapping is where the overlapping between the two of them, where the two of them overlap is where you put your line and draw it across. You understand? So that in future it can support price higher. I want you to go to your chart to backtest this. Look for so many places where it happened on your chart. You understand? And learn how to adopt it as a trading strategy. If you find this video helpful, guys, don't forget to like, share, and subscribe, and turn on the bell notification so that whenever I post videos on my channel, you'll be notified.